Hey guys, welcome to another video. We're going to continue the talk on technical analysis, and today we're going to talk about another indicator called Relative Strength Index, also known as RSI. It is actually one of the most popular technical indicators, and it is very useful in terms of predicting price movements. So let's take a look at this slide over here. First of all, what does RSI tell us? It tells us whether if a stock is overpurchased or oversold. So as you can see at the top of the graph, we have the price movements in candlestick charts. And on the bottom, this is the RSI. And the RSI would be fluctuating between 0 and 100. In general sense, if the RSI is above 70, then it is considered as overbought. And if it's below 30, then it is considered oversold. So pretty simple to understand, right? So to actually understand how RSI is calculated, let's take a look at the calculations. We won't go into details on exactly what all of this is done, but it is important to understand how it is being calculated so you get a gauge on why this works. So to calculate relative strength index, you have to first calculate the relative strength, which is considered as average gain over average loss. Then you use the below formula, 100 minus 100 over 1 plus the relative strength, then you will get a number that's between 0 and 100. So this might not make too much sense right now. So let's take a look at an example. How do we calculate the average gain and average loss? Whenever we're talking about average, of course, it means it has to be between a period of time. And in general sense, the default of the period is 14 days, meaning that we are calculating the average from the last 14 days from the data point that we're calculating for. So let's say we're calculating for May 1st in this case, then we're looking at the last 14 days before May 1st and find the average gain and find the average loss and find the ratio between the two. So how do we calculate the average gain? Well, because it's gain, right, we want to look at the green candles. Green candle signifies that there has been a higher price at the end versus start of the day. So we look at, add all of these gains together, divided by 14 in this case. And then we also do the same thing for the red candlesticks, which is the average loss. We add them all together, divided by 14. So then we'll get the average gain and average loss, and then we can find the ratio. So if we look at the RSI, this below formula, why does this work, right? Well, if we understand the logic here, you'll realize that if the average gain is higher than the average loss, then you actually end up with a number that's lower in this case, where on the right hand side, the 100 over 1 plus RS, right? If average gain is higher, then this ratio will be bigger, right? And 100 over a bigger ratio will give you a bigger number, a smaller number. So in this case, 100 minus a smaller number will give you a bigger number. If that doesn't make sense, it's okay. Just take a look at the formula again. Understand that if you have a higher average gain, then you'll end up having a higher number with this formula. And that's why, again, if the RSI has a over 70%, then we consider it as overpurchased. And if it's below 30%, then it's considered oversold. Great. So now the important question is, how do we use RSI for trading? Most people think that since RSI indicates whether the stock is overbought or sold, you can just trade in the opposite direction. So for example, they think that since it hits the 70% over here somewhere in the early June, then they will just trade in the opposite direction, so sell in this case, right? But if you look at this, even this example, right? Even though sure it does go below, but it takes a while to actually go down. right? And this signifies that it's not correct to just sell right away, because the stock can actually stay in the overpurchase territory for quite a while. And imagine if it did, right? Imagine it actually stays in the overpurchase territory for a while. The price actually could have went way higher, which means that the seller who used this incorrect strategy would have lost a tremendous amount of money. So why is that the case? Well, we talked about how a stock tend to persist in the trend that is currently in, meaning that if it's going up, it's more likely to stay going up than start changing direction and start going down. So what you want to do is you want to wait for the stock to actually go back to below the overpurchase, this trend line over here, then you short the stock. And vice versa, if you want to buy the stock, you want to wait till the trend actually reverses already and come back to above the oversold territory, then you start purchasing the stock. This way you will avoid maybe this prolonged period of being overpurchased or prolonged period of being oversold. Let's take a look at an example on TradingView using Bitcoin, right? So I never talked about Bitcoin, but this is actually an interesting story to tell with Bitcoin through RSI in this period around late 2020. And we all know that Bitcoin has been on a bull run for the longest time, since maybe late 2020 all the way to early 2021 or mid 2021, right? So in this case, if you use RSI incorrectly, I'll demonstrate that the buyer or the seller in this case would actually have lost a tremendous amount of money, right? So, and the reason why, maybe people like looking back will be like, hey, why would anyone even sell Bitcoin? That sounds like a stupid idea, right? But you can imagine Bitcoin was on a long downtrend, a long bear market for a huge period of time from 2018 to 2020, and there's a lot of capitulations where people didn't believe in Bitcoin anymore. So it is likely that people would use RSI in this case, and maybe they would have used it incorrectly. So let's take a look at around October period, right? And you can see that Bitcoin is in like this fluctuation of up and down, up and down, up and down, right? So around October this time, the Bitcoin hit another trend line over here, a resistance, and they started going down, right? And it started going back up again. It hit this overpurchase territory, and maybe if you're using it incorrectly, maybe someone will start selling right away. But if you look at this, it actually stayed overpurchased for a long time, even though it started going down around here. By the time that it's going down, the price is actually already so much higher than when the seller would have sold it in the first place. So let's say if they use a strategy incorrectly and they sold it over here, and by the time it went down, the price still went up 35%, which means the seller would have lost 35% of their money. So that's why it's important to wait for the price to go down, right, before you actually trade in the same direction. And another thing that you want to note, that over here, even if the seller started selling at this point, they would still have lost money, right? Bitcoin still kept going up, and in fact it went up like 10x from this point. So that's why I want to emphasize again, indicators, they are circumstantial. They work in certain strategies, but they do not work in all the stocks. You cannot just apply RSI across the board, use every single stock for RSI and expect it to work. RSI does not work very well with growth stocks, things that are consistently going up. Things like Bitcoin, which has a huge tendency to spike up, is not really a good idea. So usually with indicators, you want to apply it for the strategy that it works best for. And in this case, RSI, the strategy that works best is something called mean reversion. And we talked about this a little bit in the previous video, and we never really went in depth. And maybe we'll go have a separate video on the mean reversion strategy. But I just want to emphasize again, you don't want to use indicators for every single stock. And this is something that's really important and a lot of people forget, right? So RSI actually works best with stocks that fluctuate between a point and it tends to revert to the mean. If the stock keeps going up, then just like you saw right now, as I have shown, usually it wrongfully predicts when you should be trading. You also want to look at other indicators. You want to look at the overall trend. If the overall trend is going up, then you probably do not want to short the stock, right? And vice versa, if the overall trend is in a bear market, you probably want to look for opportunities to sell the stock rather than to buy the stock. Okay, I hope you enjoyed this video. Today we talked about RSI and some of the important points, such as how does it work, why does it work, and also what kind of strategy does it work well with. If you like the video, please comment and like and subscribe. It will help my channel tremendously. Thank you.